Hey guys, welcome back to the YouTube channel. In this video, we're going to be breaking down our $1.4 million unit block purchase. I'm going to be sharing with you all of the numbers that made up that deal. We're also going to be running through the annual profit and loss. So what we expect to receive in income for the property, what the associated operating expenses and interest bill is, and what the net income on the property is at this point in time. I'm going to show you a few different scenarios as well as we can increase the value on the property from a capital base, as well as the potential income increases to lift the rents up towards market rate. Now, my name's Luke. I talk all things real estate, renovating, and financial freedom. If you haven't already, make sure you subscribe to the channel down below and drop a like on this video if you find any of this information useful or helpful in your investing journey as well. And head over to purposeproperty.com.au if you're looking for a Brisbane buyer's agent. Now, let's dive into these numbers and share this deal analysis with you. If you haven't seen my video already, we purchased a $1.4 million unit block in Coffs Harbour, and it has a land size of 968 square meters. It has 9 bedrooms, 5 bathrooms, and 5 car spaces. And a little bit of extra due diligence for you guys is that this area wasn't flood prone or fire prone, and it didn't have any granny flat potential because the property itself was already being used to its maximum potential. It's a medium density residential block with a house at the front and 3 units at the back. So that's an overview of what the property looks like. Now let's dive into the numbers. So you can see here, as we've discussed earlier, it was a $1.4 million purchase price, and we purchased the property at auction. With our due diligence, we calculated the additional costs that might be involved, and we're going to break down the actuals here. So the first expense on our list in terms of making that purchase was to have a solicitor review the contracts and work on our behalf. Now we paid $1,018. Not everyone's going to pay that amount. Because I'm a buyer's agent, we had connections and we're able to work with a trusted solicitor and get a discount for those services. So that's a little bit cheaper than you would usually expect, but we paid $1,018 for this deal. Next was stamp duty, and this was pretty hefty. So $61,587. That money obviously goes to the government to allow them to essentially raise revenue. And let me just give you a quick percentage on the purchase price. So as a percentage of the purchase price, that represents a 4.4% of the purchase price paid in stamp duty to the government for purchasing that property in New South Wales. The next was we had to register the property with New South Wales government, so that was a land registry fee. So that set us back $443. We didn't have to do any of that work ourselves. It was handled by the lawyers at settlement, but that was an expense we had to cover. Next was the electronic settlement fee, and I'm also going to show you the PEXA settlement fee at the same time. So those are essentially fees that we have to pay for the electronic settlement to occur. Now, most of the solicitors use a platform called PEXA, and all PEXA is a digital platform. The solicitor can essentially have all the numbers run and action a settlement at a point in time. It allows it to all occur instantaneously, and then the funds to clear to the relevant parties based on the settlement statement. So we had to cop those fees, of course, to cover that electronic settlement. Now we paid a loan application fee of $7,383. Now this was because we struggled with this deal, so I'm going to reveal a bit more of that to you right now. So initially, we had full pre-approval for a purchase price up towards the $2 million price point, and we were doing that on a residential basis. Now, we discussed with our lender that we were looking for a unit block purchase, and we were looking for a non-strata titled unit block. All that means is that all of the dwellings are on one title, rather than having multiple titles, for example, 4 titles for 4 dwellings. Now, lots of financial institutions struggle with this understanding because it creates more risk for them as a lender. So if you have one title for 4 dwellings, you're not going to be able to appeal to sell that property to a homeowner or an owner-occupier. You're only going to be able to sell that property to an investor. Whereas if you're buying a duplex or a house and then a granny flat, more banks will look at that option with only 2 dwellings on one title, because you could potentially sell it to an extended family, and there is a market there for owner-occupiers to want to have that dual setup scenario. The classic is the granny flat, so to have the grandparents live in a dwelling that's attached or detached and nearby, and therefore you can get residential lending. Now, we had residential pre-approval for this unit block purchase, but came into a stumbling block around 4 dwellings on one title. Thankfully, the seller was a lovely person and enabled us to ask for an extension on the settlement timeframe to obtain commercial funding in this situation. So our lender reported back to us 3 weeks into the 4-week settlement that it had failed at the final hurdle around 4 dwellings on one title. Now, this was a bit of a stressful event for us, but we managed to obtain commercial lending, which means that we had to pay this loan application fee. Under a residential lending scenario, you wouldn't have to pay this $7,300, but for our case, we had to pay a higher interest rate and a loan application fee to get this deal across the line. So that issue wasn't technically on us. We had done everything and provided all the information around the deal, the contracts, our plans, and what we were looking to achieve. There just appeared to be a fallout in the credit assessment process where we were looking at 4 dwellings on one title. Now, we paid that $7,300, and the other expenses in our settlement were council rates and land tax. So when they settled the property, they had to clear these balances for land tax and council rates as part of the settlement, and that was $7,862. And then building and pest, we didn't actually have to pay in this circumstance because a building and pest had been performed prior to the auction scenario. So we had 4 reports, one for the main dwelling and one for each of the units, and these were really well done reports and very thorough. So we were comfortable that we didn't have to obtain a second building and pest just to double check those reports. And we were even able to call the building and pest company and have a conversation to discuss those reports further. Now, what that means is, what is the total cost of this deal? It's not just a $1.4 million purchase price. There's all these additional on costs, is what I like to call them, or additional costs, as part of that purchase price. So the total cost involved was $1,479,000 and a bit of change as well. So close to $1,480,000 in terms of getting this deal all the way across the line. So the real question here is, how do we fund that deal and what do the cash flows now look like? So if we scroll down, we can show you that we obtained debt of $980,000 on this deal. So that's a 70% LVR. And the cash we put into the deal was $499,491. Well, let me try that again. $499,491. So if you want to round that up, we've put 500 grand into the deal, $980,000 from a commercial lending approach, so our commercial loan, and that gives us the total funds to complete of $1,479,000. Now, I know that's a whole lot of money to make a big purchase, so let's jump into the annual cash flows and look at what the gross income and the operating expenses are to give us a net return at this point in time. There's a lot of numbers here on screen. There's the current situation, a low appraisal, and a high appraisal. Now, the current rent for the property, as in what's under contract, is $1,425 per week. Based on the rental agency's appraisal of the property should be renting for $1,740 or $1,820 within that band. Now, we've given instructions to our rental managers to slowly increase the rents. Some of the properties are locked in till late this year, and other properties will be raising the rents towards that low end appraisal to begin with. We're not going to jump all the way there in one go because that could be quite a large jump for the tenants, and based on the chats we've had with the real estate agency, these tenants have been long-term tenants and have been great to the property and great to the previous landlord. So what we want to do is incrementally make our way up towards that low appraisal in terms of rental price, because we don't want to sell ourselves short, and we have paid a lot of money to buy this property. So it needs to make business sense, but we're also taking into thought that these are long-term tenants. So let's incrementally make our way towards that $1,740 per week. Now, we like to use a 50-week occupancy, so have 2 weeks of vacancy each year as a buffer as part of our cash flow calculations. That gives us a 96% occupancy rate, and therefore the gross incomes in each of these scenarios are $71,250, $87,000, and $91,000. What that means from a gross yield on the purchase price is it's 5.09% based on the current yields over the $1.4 million purchase price, and the market appraisal is 6.21% to 6.5%. Now, a lot of people might be thinking that's a really low yield for these properties, even 6.5%. You could have gone to a commercial deal or done something different, but Emily and I understand residential property. We were looking for more of a cash flow play, and the key criteria for us was over a 5% gross yield with some value add potential on the property. So some of the apartments or units, I should say, in this property have some value add potential. There's bedrooms, bathrooms that could be repainted and refinished. There's kitchens that could be gutted and fitted with new kitchens from IKEA, for example. And I actually quite like renovating myself. So I have plans in the next 3 to 5 years, as each of these units become vacant over time, to go down to Coffs Harbour, renovate those properties myself, document the journey for the YouTube channel, and share with you the spend in terms of the capital intensive spend in terms of doing those projects, and the eventual return from that hard work. So whether that's going to give us an uplift in the property value or an uplift in the rental yield as well. So let's dive into the current expenses on the property, and we're going to look at the main key areas. So I've kind of grouped these into the main areas. So you've got interest. Now this is $42,140. Now that's based off a 4.3% interest rate, which is what we received for our commercial loan. Under a residential loan, we were looking in the mid 3.5% range, so in the mid threes for an interest rate. We ended up getting a rate of 4.3%. We might look to refinance down the track with a different lender, but because we had the property under contract and we really wanted to settle for the seller, we're happy to just get the deal done at this rate, and we'll potentially look to refinance it in the next few years, pull out some equity potentially, and maybe get a better interest rate at the same time. Now, insurance on this property is $2,524. I'm happy to share with who our insurer is, so we went with the NRMA in this circumstance, and the reason being is we felt that we were going to get a good deal with NRMA. They'd historically had insurance over the property, and so it made a simple handover for us to obtain insurance on this property too. With insurance, I always like to use the maximum excess. This doesn't work for everyone, but this is my hot tip. If you're getting insurance, ask for a $5,000 excess, which is typically the maximum, rather than $750. All that means is if you're going to make an insurance claim, you have to cough up $5,000, and then the insurance company will pay for the rest. Emily and I never plan on spending or using our insurance unless it's a big deal. Otherwise, we're going to have our own buffers in place and our own cash set aside to do minor things that are less than, say, $5,000 or $10,000. Now, insurance is a really important thing to have, so you've got to make sure it's in place. And the other thing that we made sure, given that this is interstate purchase for us, was that we had a property manager in place. So they've given us a great deal at 6.6%. Property managers can range for anywhere between the low sixes up to the, say, 8-9% range on average. Because we've given them the entire block and given them repeat business, we got a great deal in terms of the rate they were willing to charge for this property management. So that equates to $4,703 each year. And then the last two sections are rates and repairs and maintenance. So rates are roughly $11,000 each year for the property, and we've got a general repairs and maintenance budget of $5,000. It's roughly about $1,250 for the house and each of the units, and that's just for general repairs and maintenance. That doesn't include capital works we plan on doing on the property. That's just so in our head, when the agent says, oh, you know, we've got a door hinge that's come loose, or we need a handyman to come out and look at the property for a leaky tap, we've got that budget in place in our mindset already, so we don't have to stress about it. It's part of the cash flows. People are living in real properties here. Things can and will go wrong, so keep that buffer and budget in place. That means total expenses is $65,415 in its current form, with a net income based on the current cash flows of $5,835. That's putting money in our pocket every year. And when we bump those rents up, we're looking to get around $21,000 over the next 12 months, as we look to get to around $1,740 per week in rent for the property. And on the high end, if you were used to the high end of the market appraisal, you'll probably be able to attain, before taxes, $25,585. So this is going to become a big part of our cash flow within our portfolio. As we look over the next 12 months to move to around about $20,000 or $15,000 worth of passive income from this one property, and add value to it through renovations over the next few years, and expect that the price growth will continue to occur and drive in this area. We think that we've made a great purchase, but what do you guys think of the numbers? Now you've seen the deal end to end, all of the on costs involved, all of the cash flows. is this a good deal? Is this a terrible deal? Should have we gone for a commercial property that was industrial or retail or office spaces? What do you think of the deal? And what do your deals look like when you run these numbers over the top of it as well? So if you're looking for your own calculator, you can head over to purposeproperty.com.au. There's a free investing property calculator where you can plug numbers in, or you can just take down notes from this spreadsheet and come up with your own calculations for future deals as well. If you found any of this information useful, make sure you drop a like, subscribe to the channel, and click this video over here for the next thing on real estate, renovating, and financial freedom. I'll see you in the next video. Peace.